Guys, welcome back to the Independent Investor channel. I made my investing later on in life. A couple months back, I was still in New York. I've since relocated to Virginia, and this will be the second installation of what's really been one of the crown jewels on the Independent Investor channel. I really enjoyed making my last video talking about the idea that folks that are perhaps maybe still working, maybe retired, have been retired for quite some time, to look at the stock market as something perhaps that they could take advantage of as well. And I have a very unique perspective on this, and this is going to be one of the most important videos that I come out with. I really love doing military investing videos. Obviously, I've got a very important message to send to young people, folks getting started in the stock market. But the message that needs to be geared toward investors that are looking to maybe top up an investing portfolio, get started in the stock market, and have never invested in the stock market, that's one of those things that I really enjoy. So for you guys that typically tune into the channel to get, a quick 5 to 10 minute video, this is going to be a significantly different approach for me. I really just want to strike up a discussion. On my first video that I released addressing this topic for folks that may be looking at the stock market to take advantage of. And the thing about it is, I think there's a lot of reason for that curiosity to be perked nowadays. And number one is the access to the market. Number two is the products that are available to investors now. And I don't care what age you're at. I mean, I have a hard time speaking until I'm blue in the face for young investors to really understand that it's right there for the taking. And for my community that have worked long careers, whether it be in your 40s, 50s, 60s, or 70s, or beyond, I don't have to set those ground rules with you guys. And this is an interesting position for me in that I'm 41 years old, and I've been investing for most of my life. And the clarity that I have on the stock market is significantly different than the perspective that you may potentially hear from a financial planner. I get to pulse in with going on 10,000 people who communicate with me on all the different products that are out there on the market, different interactions that they've had with their experience with financial planners, what type of advice they've got when they've went in and spoke with them. And the thing that we really pride ourselves, or at least I do when I'm speaking to my investors that are looking to take advantage of a program, I really want you guys to understand that this is not a run-of-the-mill approach. It's unique. It's deeply rooted in sound financial decisions, but there's a couple things that I mentioned that I feel like are all too often overlooked when we are talking about some of the goals and how they've evolved or potentially matured over time as you've grown your wealth over time. And I think a lot of people, when they were excited about hearing this series 2 of the video, is I did about a half-hour introduction on the first video talking about, more of a mental conditioning to entering to the stock market, because everybody really does have their own motivations as to why they may start. Perhaps maybe the landscape has changed so much that they've just justified it into making sense where maybe it hasn't made so much sense over the years. The flip side of the coin is that the stock market nowadays is just about as volatile as it can possibly be. And I don't think it's going to get any better. I think with the introduction of machine trading platforms like Betterment that will invest your money automatically, and the algorithms really control the trading activity within those accounts. And when the volatility starts to pick up, you guys will kind of notice that the stock market will really start to snowball. Some of the questions that I pose to some of my audience, if you're 52 years old out there and you're watching this video and you're saying, well, I'm interested in the stock market, but what are some of the realisms of a decision like that? You know, if you're 52 years old and you take some investment capital and you put it to work, and those investments take a haircut of 30, 40%, is that going to be something that you're going to be able to overcome? Is it going to affect you emotionally? Okay, it affects young people because they don't have the conditioning in the stock market to deal with the swings. And I always say I won't apologize for those because those are inherent lessons to be learned at a young age. Do we have that flexibility and capability later on in life to subject dollars to that type of volatility? All right. Now, the answer is yes, but with relative scale and perspective in the stock market. All right. We're not getting involved in the stock market later on in life for the fun of it. We're not. All right. The stock market is serious business. All right. We use trends in charting to let us know what good entry points may be presented in a particular stock. We look at historical performance of the stock market to anticipate the potential for future returns, but there is never a guarantee in the stock market. Anybody who tells you that there is crazy and delusional, and they're probably trying to sell you something. All right. I'm not trying to sell anything to my crowd that have put maybe 30 or 40 years in the system. All right. I don't need to do that. All right. The folks that tuned into the last video, I think they really appreciated being spoken to and not being spoken at. And there's a big, big difference. And my perspective comes from a position of thinking that the approach, as long as it is well-defined, can really, really help some of our elderly community who may have built up a nice nest egg. Perhaps maybe you're out there and you've got an existing 401k or a teacher's pension. Maybe you're a firefighter or a police officer and you're sitting on some time there, and you might have some years left. You may already be retired. All right. The stock market can be an excellent avenue for topping up existing investing. Maybe you have some surplus capital, and I speak to my audience that are in their 50s, 60s, and 70s as potential candidates to have just that. And I think that's what a lot of folks out there that have earned that right to enter into the stock market, contrary to maybe what they could be told if they went in to talk to a financial planner about what their options are in the stock market. Guys, I've heard horror stories. And I don't always mean to be bagging on the financial planners, okay? But they are looking for candidates to sell product to, all right? If you go in there, irrespective of your age, and you're looking to invest in the stock market, make no mistake, guys, that's exactly what they're going to do for you, all right? And the level of compensation they get to put someone's hard-earned dollars into the stock market in way of a high-fee mutual fund or multiple mutual funds, I think is just dead wrong. It's just dead wrong. And there's a lot of folks out there that would agree wholeheartedly with me. They would. I don't partially think that this is right. I know it is. And again, there's a lot of good folks out there that have put in really good careers and deserve the respect to be spoken to as if they need to know what their options are. They don't need to be sold a product. Most of them can identify, like I can, whether or not I'm going to be sold something. And that's typically where I'll turn that source of media off, because I don't appreciate being sold something, okay? It makes me feel weird. I just don't like it. I don't like selling things to people. And that's typically where the two programs, the one that I speak about all the time with regard to the importance of wealth preservation over time, of course tax protecting your money, and you guys know all about that, so I don't need to speak along those lines. But what about the importance of cash? What about the importance of defining your level of exposure into the stock market. If you've just had your portfolio growing over time and you haven't paid attention to what those dollars have grown, maybe you check in on it every year and you've noticed that the portfolio has grown quite significantly. What's the last time you've thought about actually reducing some of your exposure as you get older? Those are some of the questions that I would pose. How much fixed equity do you actually have? What products could you invest in to actually enjoy some of that fixed appreciation security over your money with regard to the corporate bond side or the U.S. Treasury market? So if you don't have an idea of how much percentage you have devoted to those, now is the time to start utilizing this community to ask those questions. I certainly want to be the conduit for conversation and to open up a dialogue on a topic that I offered last time. It was one of my most popular videos, and rightly so. There was a ton of people who hit me up and thanked me for doing it. Before I made the video, there was a lot of people who asked me to do it. And this is going to be installment 2, and I hope to build upon a lot of the psychological stuff that we talked about, some of the ground rules that we spoke about in the initial video, all right? Part 2 is going to build upon those principles as well. But I really want to just touch on kind of a 3-part, and we're going to walk through this as more of a discussion because I really want to be as holistic and transparent with my idea that if I was in your shoes, and it's very, very difficult to do, if I was sitting across listening to a 41-year-old guy, okay, give me the answers, Ryan, what do you got? And I'm 52 years old and I've worked and I'm sitting on $500,000. What do I do? If I'm 68 years old and I've been retired for quite some time and I'm living off of Social Security, what is it that I can do? All right. And there are solutions for everyone. There is. I don't discriminate against people to say that it's too late in the game. I don't buy into any of those cliches. I don't. I think you can be a successful investor no matter what your age is. And the best candidates to be successful investors, because they've learned the life lessons that typically it takes to weather downturns and be disciplined in the stock market. I don't need to explain those things to you. What I do need to explain is investing in the stock market is a very, very unique exercise. It really is. All right. You may have been able to outwork certain people, maybe in your job force, maybe coming up through the ranks in your careers. Maybe you've been able to just outwork things, right? The stock market is not one of those things that you can just outwork and succeed at. You really have to take more of a mechanical approach, and you have to have a plan that's rock solid on paper, not invested $1 whatsoever, but to have a rock solid plan that you are willing to stick through thick and thin. And the trick for the 52-year-old and the trick for the 68-year-old is to define what it is you want to get out of that strategic plan and what products we can put to work in each one of those scenarios. Now, I know there's going to be a ton of people that come on to this message and they're looking to engage their own thought, and that's specifically what I want to do, is to propose some thought-provoking ideas for what it can mean for you, because I'm not going to be able to sit across from all 5,000 or 10,000 people that are going to watch this video and say, okay, you've got $250,000 here, maybe the wife's got a pension with maybe $400,000 in it, how much income? I can't do that. But what I can do is talk along the lines of general investing philosophies. And hopefully that can kind of help you and say, you know what, we're doing this. But Ryan mentioned something to say, I can do this, and I may be able to do a little bit more. Or maybe I've got this in place and I've built it up over time. Perhaps maybe we can leverage some of those funds and put it to work a little bit more strategically in our portfolio. Furthermore, you may want to just take an objective look at your portfolio that's been built up over time and just ask yourself, is this a time in my life at my particular age that I want to be invested as much as I am? Perhaps maybe you're 76% leveraged to the stock market, and potentially that just might not be where you want to be. And just because I'm posing the question, you're kind of forced to look at it and say, what is it that we have? What are some additional options? And those are some of the discussions that I'd like to foster in the community on this particular video. This is going to be a little bit different, where I'm addressing people specifically in the community through the comments, and I'd like you guys to interact with each other as far as what are all the options, how Social Security is allowing you to get by, how is it that the investments, if you have any, are supplementing that income. You know, is it allowing you to travel when you want? Is it allowing you to survive? Are the basic needs being met? Does life insurance play into it? Do we have some precious metals exposure in the portfolio? Where does real estate fit into the picture here? All right. So these are all some of those idea generating conversations, and that's really why I put out these videos, to kind of bring our investors that are approaching retirement into the discussion, because I know there's folks out there that are raising their hand and saying, I want to be a participant too, Ryan. What are my options? And the landscape's changed so much, so hopefully we provide some value defining some of those valuable assets that are out there right now, because they're out there. They really are. The first thing and the most important thing, obviously, is to define your goals. And this may seem a little bit cliche, but you cannot come to me and expect that I'm going to have a magic plan for you if you're 52 years old and you haven't saved anything your entire life. Now, that doesn't mean that we don't have a plan for you, okay? But you need to have realistic goals. And for a lot of you guys, I don't need to sit here and tell you what your goals are, but what I can say is the importance of defining a goal, as short-term as it may be, because you may be 52 looking to retire at 62. And that's what I mean by short-term. You have 10 years. So the goal has to be defined to say, I'm going to implement a plan at 52 and I'm willing to see it through to 62. All right? So the goal setting piece here is super, super important. And the exercise that I want you guys to run through is to identify a realistic time frame for these assets that you're looking to put in motion, whether it be in a brokerage account or if you're eligible for the self-directed Roth IRA account. Perhaps still you're making that earned income and you've been contributing to a 401k, but you never thought about starting a Roth IRA. If you're 52, you've still got 7.5 years to start to contribute, and you've got the catch-up funds as well. So not only can you do the 5,500, but you can also do the 60. You can do 65, an extra 1,000 for any year after 50. So that's one of those milestones I think that you guys need to understand is there as well, is that anything after 50 years old, you're allowed to do catch-up contributions. All right, so if you are 50 and you did it for 10 years, you could be sitting on $65,000 of contributions with zero capital appreciation. After 7 years, the rule of 72 projects that you could potentially have one doubling cycle within that time. That's $130,000, right? So it's nothing to shake a stick at. And that's why I'm saying, even in a tight time frame like 10 years, if you were willing to define your goal and define a realistic time frame, and you guys might be early 50s, you guys might be early 60s, and say, you know what, I'm in a project. Perhaps you're in your 60s, 70s, and you're still continuing to do real estate. A lot of you guys out there are just continuing to work. I will be one of them. I love working, okay? And there's a lot of folks out there that are in this camp of wanting to continue to work. You are a perfect candidate to redefine your goals and say, you know what? Ryan's talking to me. I'm 57 years old. I've got a significant amount of time left to work before I look to turn the corner and retire, right? You could realistically fit in a 10-year time frame of portfolio building, all right? So we'll get into what makes you eligible and how to maximize that 10 years. But you have to have a genuine fire, of course, and an interest to get involved in the stock market. But we must define the time frame that we are willing to subject to potentially a new program in addition to either an existing program or an initiation of a new program, all right? And those two things are going to be strategized a little bit different, all right? We will talk about that a little bit more, but time frame is key. And the older that you get in life, I think you guys can all agree how important it is to define that as crystal clear as you can, all right? A lot of young folks, they'll come up to me and they'll willy-nilly throw out a goal, and it's not realistic, okay? I don't have to do that with my crowd in their 50s, 60s, 70s, 80s, and beyond. They don't need to have me tell them what a realistic goal is. You guys already know what those are. You guys could probably have a goal, not write it down, and implement it better than our younger folks that are looking to invest and become millionaires, right? So you're much more realistic about what is possible, what is the mathematical probabilities. Of course, what is the probability of entering into investments free of charges, right? That is absolutely critical. Time frame. Time frame is one of those things that falls under the goals category, and I cannot stress enough how important that is. The next item under goals that we need to figure out is what level of risk you are willing to take on. And I'm not going to be one of those folks that sits here and tells you that you can't invest in Google, all right? I'm not going to do that. I'm not going to be one of those investors that say that you can't buy Apple, okay? You could invest in Apple at the wrong time at 220 and have it adjust to 175, and you're down 25%. That is the risk of entering into single stock allocation in a portfolio for the idea of future upside potential, okay? But you really need to ask yourself, what is it that I'm willing to subject my money to? I think those options are fine, but we can look at different options across the stock portfolio and say, you know, for a conservative investor who is looking for dividend income and wants that 10-year program to produce good dividend income after a defined time frame of 10 years, perhaps maybe we need to be looking at dividend-paying stocks that have paid, you know, over the years, and look to build that portfolio strategically of, you know, good utility stocks in there, maybe a good insurance payer, all right? These are some of those ideas that if we house these assets within the portfolio and we have a defined goal as to what we want from that money, we want dividend income. Now that's a realistic goal. We can build that 10-year portfolio to put yourself in a decision to say, you started from 0 at 52, now you're 62, okay? And we look back at the decision that you made when you're 52, and now you're 62, and you're sure as hell glad that you did it, right? In retrospect, you made a decision to start. Not quite sure why, but you came up with a goal that you were going to reevaluate at 62, and you're there. And you look back over the decisions that you've made over that time frame of 10 years, all right? You've defined your level of risk, all right? So it doesn't mean fill your portfolio up with the Facebook and the Googles of the world. And I'm not saying you can't invest in that. I'm just saying that those stocks or assets that go into that portfolio must be in line with your financial goals. If we're going to use that self-directed account in the way that I want to use it for, or the next best thing is we're going to get you into a brokerage account that you can invest in the same stocks, okay? But depending on what you're eligible to contribute to, that is how we're going to strategize what dollars we put within the Roth, if you're eligible, and what dollars, if any, surplus exists to place outside of the Roth. Very, very important. Very, very key takeaway. We want to maximize the Roth, and we want to maximize the potential within the Roth, all right? But you guys, may just have more than the $6,500 allotted to you after 50 years old, right? You may come to me and say, Ryan, I've got $1,500 of surplus cash a month. I'd like to strategically put that to work. Fair enough. We're going to go to cash. We're going to go to fixed equities. We're going to go to a dividend portfolio, right? We're going to do all those things, but we're going to do it within reason. For you folks out there who want to strategize and do the same thing and pick up some assets within that Roth IRA account, if eligible, if not eligible, the brokerage account at $100. We can do that as well, and we can forecast where those accounts are going to be over time. Again, to define your risk and build the strategy based on your goals and what you want out of it, all right? The very, very most important thing within this goals section is you need to ask yourself why, okay? Why is it that you're subjecting your dollars to appreciation, okay? The stock market is volatile, and I don't tell you that to scare you off of investing. I come out with this video to level the playing field. I break through barriers for people. I don't believe that because you're 50, 60, 70 that you can't invest in the stock market. I actually believe the opposite. I actually believe that you should invest in the stock market. Furthermore, I believe that if you're 50, 60, 70, I think that it could be strategically imperative for you to enter into good quality single stocks as opposed to buy the index with the stock market in its current condition, okay? So those are all questions that we need to ask, and the most important thing is to sit back. If you're with your spouse, you guys both work, one works, one doesn't matter. Sit down, have a cup of coffee, have some tea, have some wine, whatever it is that you do, and ask yourself the fundamental question of why. Why? Is it because I got you excited about investing? That's not going to work. That's not going to work. I put out this information, right, as holistically as I can to get you to think about why. And if you can't answer why it is you're looking to potentially subject dollars to the stock market, and you can't validate the reasons to do so, or you're going to cut back so severely on the day-to-day activities that you find so important in your life, or it's going to prohibit you from living a healthy life, because if you're not prepared to enter the stock market in, let's say, a single stock allocation, you can't lose sleep over this, guys. You can't, all right? You have to be mentally tough. And I hate to even use the word tough, because to succeed in the stock market, you have to be robotic. You have to be mechanical. There's nothing natural about throwing thousands of dollars to something that exists on a computer screen because somebody says you own 10 shares of that particular stock, you know? I mean, 10 shares right now of Apple's over $10,000, right? So you sit there and think for a second, or over $1,000, and then, you know, 100 shares right now, I mean, that's going to run you some serious coin, over $10,000. And a lot of people would sit back and go, yeah, I hear you, Ryan, but I'm prepared. I get it. I understand the value of the compounding payments into the dividend, right? I understand, and I need to maximize this strategic goal over here that you talked about. I've got one of those accounts, and I need to put some money to work in there. But you guys need to sit there and have a serious discussion as to the why. And there can be some tools that I'm going to talk about here furthering in this discussion about helping you understand why, okay? And if you do have some concerns when you're asking yourself why, there's always mitigation. There's always ways of adjusting your levels of exposure to make sure that you're being honest with yourself before you invest one penny in the stock market. This is things I talk about through the life of the channel, and I don't want to see you guys expose an unnecessary level of risk to the stock market and miss out on some of those things that I talk about that are way more important than anything that I can try to propose via financial, okay? Because financial security is extremely important. money is not, okay? There's a difference there. There really is. You can have money and be unhappy as hell. I know folks like that, all right? We're not looking to do that. We're looking to enrich our life. There's a significant difference, all right? The strategy. The strategy exists when you're sitting there defining your why and understanding what it is that you have in your existing portfolio protocol, okay? What you have existing, what you've built up over time, what you hold in life insurance, what you hold in long-term care, what you have in cash, what you are doing for college funding if appropriate, what you have in business savings, what you have in real estate. This is an accountability for your assets. That is what it is. This may be the stage that you might want to take a pad and a pen paper out. And when you put pen to paper, you might get the answers that you're looking for as to whether or not you can answer the question of why and justify whether or not you have some surplus or whether or not it makes sense for you to enter into the stock market. This is really what we're looking at, is to define the status quo. I don't care if you're 52, I don't care if you're 88, okay? The rules are the same when we are looking to define our existing assets, okay? It's no more than just taking an accountability on a budget for what assets you have, all right? What we are trying to do is to understand what we have under an existing portfolio and whether or not there is room for proposed improvement, okay? That is what we are looking to do. I find all the time that folks in their 50s, 60s, 70s, and 80s don't have any idea of what they have, okay? You cannot come to the Independent Investor channel and expect me to just layer on. You don't know what the underlying assets are. You have no idea what they've grown to. They have no idea what your expenses are. They have no idea of what their existing assets are. So how is it that we're supposed to propose improvements on a program that we really aren't crystal clear on? And that's where it comes to the strategy piece. The strategy exists in identifying what you have and what it is that you can add to that. In most of your cases, if you're 50, 60, 70, 80s and beyond, in most of your cases, it's going to be to identify much of the foundation that I assume is already in place. Foundation being already existing assets that have had time to mature over your life and maybe supplementing that base with something just a little bit more strategic. Now, the size of that base is going to determine how much risk we take within that strategic addition or the proposed plan, okay? Are you guys with me? Hey, I love talking finances, and if you love talking finances, you will start to understand that finances is not a pragmatic discussion. It's not. It's so important to understand that the way I'm trying to speak about identifying assets is that everything goes together. You cannot build one without understanding the other. You cannot do that. You have to look at it holistically to start. Then you have to look at it individually, all right? But you're never going to understand investing unless you are willing to look at it and identify crystal clear what it is that you have and what strategically we're going to add to, all right? So stage 2, we're really looking at the how. How is it that we are going to implement our goal through a defined strategy by defining what it is that we've built up over time? Your goals can be creative. I don't care, if you want to save for a legacy, which is part of my goal, so I don't mind disclosing that to you. If you want to save up for grandchildren, if you want to invest for grandchildren, use your imagination, guys, and dare to have a little bit of fun with this. dare to have a little bit of fun, because investing can be fun. It really can, all right? Even on those down dip days when you invest in Apple at the wrong time and it goes from 220 to 175, that's the time when you smile, you step in and you buy more. That is the strength of a mechanical investor and not an emotional investor. And that's really what I want to hit and stress upon, is that I don't want you to think that you can deploy the same old tried and true work it till it's done strategy in the stock market. If you try to do that, you'll fail. You'll come back to me and say, Ryan, I got invested, I dropped 40%, I'm out, I'm done, I'm mad, right? I lost money and now I've got to try to somehow make that up. All right, there are mitigation strategies that you can think about and look to deploy to put yourself in a position where you can minimize that level of exposure to the stock market, so you're not stuck taking an emotional decision on maybe a stock trade that the next couple or the next folks looking to enter into retirement look at that and they're like, it's fine. It's all a matter of relative perspective, but the goals and the strategy come down to the specific definitions that you come up with through these first two processes of asking the why and asking the how, all right? The last thing, if you guys have sat with me, and I know that you have, because in young investors, there's no way that they would have stuck with me for close to 40 minutes of a video. For you guys that really are looking for the nuts and bolts, the product within this, now that we've got our goals and we have our strategy and we understand what it is that we're building upon in a proposed plan, the assets nowadays are significantly different, okay? I would rather do an investing later on in life without even using the words mutual funds. Mutual funds is not something that you need to invest in, and I understand Dave Ramsey's position. I'm not going to go down that road. I'm not. I think there's something going on with mutual funds that I would rather not put my thumb on during this video. But why in the heck would you want to invest in a mutual fund when you can track the index using an ETF product? Furthermore, if you're sitting back on the couch, and you guys are smart people, you've worked hard, you've had careers, you've built up some net worth, perhaps you've identified this proposed, and you're like, okay, Ryan, give me the dirt. Okay, the dirt is this: ETFs, as low cost as they may be, may not actually make sense for you. Single stock, in addition to your existing plan, may make all the sense in the world for you. All right, because single stocks are going to fluctuate in price, and where people go wrong in looking at a single stock is, yes, single stocks carry with them more volatility. It is impossible to diversify when you own single stock. Here's the key, all right? Holistically, over the longer term, single stocks typically return far greater than an ETF that tracks the market. For example, if you look at the 5-year return on a stock like Apple, I just bring it up for an idea, because 5 years ago I would have recommended that you guys look at Apple stock. 5 years from now, I would recommend that you look at investing in Apple stock. If your risk tolerance is less, no problem. We can look at a Cisco, an Intel, or an Oracle. That's fine. There's always a product at IBM. There's always a product out there for you that we can strategically fit with your particular risk tolerance, all right? But the problem with emphasizing ETFs, exchange-traded funds, which for you guys that don't know, if you guys were going to buy the entire S&P 500, it has 507 companies within the S&P. It gives you a small piece of each one of those companies. That is diversification, where if you have the failure of 30 of those companies and they rotate out and they rotate fresh new companies into the S&P, you're always getting the stable companies that are creating stable business for their shareholders, and you own a piece of all of them, all right? The problem with talking about exchange-traded funds that match the market now has everything to do with the current state of the stock market. And again, I don't want to scare people out of investing in the stock market, all right? The cliche that gets pushed out all the time is the best time to invest in the stock market is yesterday. What that means is you could potentially put new money to work in the stock market, and depending on the amount of time horizon that you have, you can be somewhat assured that over time, historically, the stock market has paid back appreciation, okay? The problem with it right now is I'm talking to an audience in their 50s, 60s, 70s, 80s, and 90s. This might not be the best idea for you to go 100% in the ETF, all right? It may not be the best thing for you to go 100% stock portfolio, all right? But these are the assets that we're looking at. The last one is the fixed equity, all right? I think if you guys are in your 50s, I think you should probably look at having no less than 40 or 50%. You can fall within that range if your risk tolerance dictates that you can have more fixed equity position in your portfolio. I recommend going with the fixed equity ETFs from Vanguard. Very, very simple. I have 6 of them myself, okay? I have long-term bond exposure, I have intermediate term bond exposure, and I have short-term bond exposure, as well as the total bond index, okay? These are all ETFs that are offered both on the corporate debt side and on the US Treasury side, all right? That's why I have 6. I have a mix over here of ETFs, very low cost products, ranging from about 0.05 expense ratio all the way up to about 0.09, I believe. They're very relatively low fees, otherwise I wouldn't recommend them, and I wouldn't recommend them because I wouldn't buy them myself. I own these, all right? Currently, I've got a pretty good fixed equity position at about 10% of my portfolio, all right? So as I start to build wealth and approach these ideas that I understand you guys to already be at some of those landmarks, maybe you're 50, 60, 70, you need to look at your fixed equity exposure and ask yourself, right? If you're 40s, late 40s, 50s, you should be looking at 40, maybe even 50% of fixed equity exposure in your portfolio. That leaves a remaining 50%, okay? What can change this approach? What can change this if through this existing evaluation, you've identified that you already have a bunch of this exposure up here? That would allow you to say, you know what, Ryan, I hear you, but I can drop this down to 25, or I can drop it all together because I've got a very, very good existing base, whether it be in fixed equities, whether or not it be in a cash pillar. Those are the two things that can supplement this 50% here. But for you guys out there that don't have that level of exposure, later on in life, we need to look at the fixed equity as the ace in that portfolio. It is the absolute anchor. It is the pillar. It is the foundation within that additional proposed plan that we are making. And the remainder of your portfolio allocation will revolve around the level of fixed equity position you decide to enter into, all right? So defining this fixed equity position here, whether it be on the long, intermediate, and short side, long, intermediate, and short side, maybe a mixture of two like I have, okay? Maybe it be through one bond ETF, depending on the amount of capital that you're looking to put to work, okay? I'm gonna allocate it different if you're looking to do 50,000 as opposed to start the account with, let's say, you know, 1,000, 5,000, or 10,000, okay? The allocation strategy is gonna be a little bit different, okay? And depending on your tolerance, the why, the how, the proposed that you want out of it, this right here is going to be your core, all right? Defining how much fixed equity positions that you want. Very, very simple to go into the Vanguard's website. I'm going to either link up a description in the comment section below, or I'm going to actually show you when I throw this video on to the editor and I'm going to show you the exact area in the Vanguard website where you can go on there and in the comforts of your home, go on there and look at the expense ratios. You can validate them for yourself. You can have all the analytics right off of the Vanguard website that you would ever need to determine what mix of products that you would want to fill this core in the product section of how we're going to implement this strategy, okay? Now the ETFs is really a fun one, because when I talked about entering into the broad market, okay, we can fill this remaining exposure, if you want to just keep the math simple, 50, 25, 25. The ETF section can be really fun for you guys. And this is kind of where I get into maybe a VIG, a dividend ETF, right? That holds nothing but sound dividend payers. So instead of investing in just 1 or 2 or 5 dividend payers, perhaps maybe you fill this 25% in the top end of this portfolio with maybe a dividend payer. Maybe you want to take on a little bit more of a value type of a play. So you buy a large cap ETF. And those are some of the offerings that come, again, right off of the Vanguard site. And then finally, the additional 25% in that portfolio. This is going to be your opportunity, man, to put some blue chip companies to work for you. Guys, they have been working for hundreds of years, some of them, all right? Johnson & Johnson, I throw out these companies all the time, Procter & Gamble, JP Morgan Chase, and some of the exposure to some of the sectors that I feel comfortable recommending to you guys. And for my investing crowd that are in their 50s, 60s, 70s, 80s, and beyond, do not underestimate the importance of this stock section in the portfolio. There could be some of you guys out there that hear my message and say, wow, Ryan's not taking away options. He's providing options to us. And that is the key and the niche of this particular message. If you're sitting there going, wow, I have this existing stuff going on, I can actually fill this additional proposed portfolio with an entire stock of blue chips. I've always wanted to do that. That makes perfectly sensible for me. Maybe I've got $5,000 to $10,000 to put to work in surplus capital. Maybe I can take advantage of those catch-up funds after 50 years old. Maybe I'm 48 years old, and then that's right around the corner, and I'm excited about actually starting a dividend portfolio for the first time in my life, right? Maybe we enter into a value ETF here, right? So we can start to really ask those questions. And this is the core piece here, guys. And what I wanted to do is present some tangible products. Why? Because you have sat through the initial message. For you guys that are coming to this message for the first time, you need to go back and watch my initial installation of investing later on in life. It's extremely important for the mental and the psychology of the stock market to really be understood. Understand where I'm coming from with some of my recommendations. You know, we didn't talk about gold, silver, real estate, but we're going to talk about that in some of the follow-on series. This is one of the most enjoyable projects that I come out with to talk to folks looking to invest later on in life. You need to leave the comments at the bottom of the video. You need to strike up a discussion about specific questions that you might have in how potentially existing programs are providing additional opportunities for you for proposed programs, and to take advantage of some of these proposals and to some of the products that are available right now on the market to you guys to be taken advantage of. If you're excited about this message and you have a hard time sleeping tonight, we've done our job, because it is exciting. It's exciting to turn people on to different alternatives. You may watch this video, you may get excited about it, only to not invest, and that's okay too. It really is, because at the end of the day, deciding to invest in the stock market, the real key and the takeaway for investing later on in your life is to define the level of exposure that you're comfortable with. That level of exposure could be an account of your total overall net assets, and to take 20% of it and expose it to the stock market. That might be your comfort barometer. It might very well be. Your comfort barometer maybe to up that to 50%, but then to buffer it and take advantage of some of these fixed equities within that portfolio. Guys, I really hope you enjoyed this throwdown video for investing later on in life. It was obviously an extended video for you guys. It's been a while since I came out with my original installation, but I was so glad to do this video for you guys. I really think we have touched at least 3 nerves on how you can strategically break down the stock market. If before this video you really didn't have an idea of how to strategically approach the stock market and we helped you get to a better place, hit the thumbs up button for me. If you're new to the channel, you absolutely want to subscribe to the channel. I would ask for you to hit the subscribe button and help us support the movement and the message that we're putting through on getting anybody that is interested in gaining some appreciation in the stock market, becoming a participant. Maybe it's something that you've always been interested in, but you've really never had the explanation to bridge yourself from a non-investor to an investor. And that's really what we try to do on this channel, is to provide that bridge of understanding for people. Guys, thank you so much for tuning in, and good luck in your investment future.